If the market is stressing you out, make sure to save money on insurance by going to metkevin.com/lemonade. You can get homeowners insurance, renters insurance, pet insurance, and life insurance, and soon car insurance by going to metkevin.com/lemonade. Check out metkevin.com/lemonade in the link down below. Hey everyone, me Kevin here. The market is shifting and it's taking an unusual path. Usually what we see is a transition between a flight to safety and risk on trading. We usually see that. It's kind of like one or the other. And oftentimes we think of it as sort of this like barbell. It's like one or it's the other. Kind of like at the beginning of the pandemic, we had, oh, it's the tech stocks, it's the Zoom, it's the stay at home. They're all doing really well. And then on the other side, you had the recovery stocks, right? The Delta Airlines, the Spirit, the Carnival. And when these were up, these were down, right? That barbell has sort of evaporated. Now we see some tech up, some recovery down, some tech up, whatever, right? We see that pretty consistently. But something else that we saw at the beginning of 2021 was this really, really big sort of risk-on movement. And it had a lot to do with SPAC IPOs, regular IPOs, DPOs, and ultimately crypto. And pretty much anything that seemed relatively innovative exploded with a huge risk-on trend at the end, or sort of, we could even say beginning of December through about March, and in some cases through April. I'm gonna show you some examples and then talk about what's happening differently now. So let's take a look here. Palantir, direct listing. The direct listing took place in September. The thing direct listed for like 10 bucks. This thing runs in December, runs into February, up to $45 at the end of January, continued renewal run here into Feb. And once we started getting that sort of market pullback around Feb 19th, we started going risk off. Palantir really started falling until just recently when we started getting a little bit more of a risk on movement. And that recent risk on movement is something that I really want to talk about. But what for right now we really want to pay attention to is look at December to about March, okay? Let's look at another one. Let's do a SPAC here. Let's do Matterport. Look specifically here at the run. We get a SPAC on February 1st. I mean, this is like the perfect time to have a SPAC because you get that beautiful run up until February 22nd. This was really the end of the risk-on era because interest rates started skyrocketing. We saw a lot of these bleed out. Let's think of another SPAC here, and we can specifically go through some of the SPACs by looking at some things that are doing really particularly well today. Let's look at Electromechanica, for example. Electromechanica, which not necessarily a SPAC, but also took a part of this crazy sort of risk on rally. Faraday Futures here. Look at that risk on rally from November through about February, middle of February there. Big old explosion here in pricing. Workhorse, go back to Workhorse. When do you see it? You see the big run from November through February. You see it over and over and over again. It really doesn't matter what you look at, if it's a SPAC or it's a higher risk play like Gevo or whatever, here you go, December through February. This was our at-risk moment of time. Which, what else is interesting? What else did really well during that time? Sorry, those lines look crazy. Let me go over to TradingView really quick because those lines are nuts that I have on Webull. Sorry, I usually have Webull much more zoomed in, so the lines aren't that apparent. But anyway, on the day chart, look at the run in Bitcoin. Look at this. November, mostly starting in December, boom, explosion. Now this lasted a little longer. It went on through about April and May, really peaking about April 12th, CPI data release time. Boom, an explosion, a risk-on explosion. And risk-on explosions, they come in waves and they go in waves. But something that I think is really interesting is that crypto seems to have decoupled itself from when risk-on trades are done. See, crypto started, hit sort of a low in the summer around July, and we had a little bit of a recovery here in August. And now we're seeing a little bit of the sort of SPAC plays start coming back fractionally, right? We're finally starting to see a little bit of a recovery here. When crypto was really starting to recover here in August, we're starting to see a bit of that recovery now in some of the more risk-on plays, things that have just literally bled out, SPACs that have bled out. I mean, here's XL Fleet. This was a stock that at $20, I said sell. It's way overvalued. It's not worth it. It's at $6.84 right now. QuantumScape, another particular stock, massively down, but recently seeing a little bit of risk on movement again. And people generally see some of these particular companies as more risky than cryptocurrencies. And this is an interesting deviation that we're seeing right now, because look at this. Even Plug Power is slowly trying to start trending back, even though it went from 75 to like 25 or even lower at one point. Another one I made a video about in January saying this is mega overvalued and probably going to have a QuantumScape style collapse, which it did. It's interesting to note that we're starting to see some of these stocks on the day have very interesting runs again, like very nice runs. Look at some of these runs here. Camber Energy, Naked Brand, Metamaterial, Electromechanica, Gevo, XL Fleet, Workhorse, Big Digital Assets, Hyliion, Proterra, and then some cannabis plays in here. Fisker, Plug Power, Smile Direct. What do all of these have in common that are between 4 and 33% up today? Well, all of them have something in common. They're all much higher risk plays. I mean, even in the after hours, you still got Camber and Naked running. Camber 4%, Naked 8%. Why is risk running right now? And more interestingly, why is crypto not continuing to run with a movement to risk on plays? What if crypto was this signal that, hey, it's time to go risk on. It's time to go risk on. Now people are like, okay, hear you loud and clear. Let's go risk on. And people are taking their money from potentially the safety plays, the Google, the Alphabets, potentially even the safety plays of well, this is a big stretch to say that Bitcoin is a safety play like Apple and Google. Okay, I'm not trying to say that. I'm just saying that what if the market is evaluating Bitcoin as safer and potentially lower gain than some of the alternative assets like SPACs or even potentially altcoins, right? I mean, look at this. For the last few days here, and this is really a recent phenomenon, you've been seeing Apple trend down. This is just recently here. Apple trending down, crypto trending down. That's interesting. It's almost kind of like the safer plays are trending down, whereas the SPACs and the crazy ones, the ones with higher valuations, and don't get me wrong, I'm not trying to diss them. I love me Matterport, okay? But look at this insane run that Matterport has had over here in the last month. It's been absolutely crazy. And you're seeing this over and over again at some of these higher risk, higher valuation plays. Palantir, I mean, heck, even Tesla has had much more of a substantial run. We just broke out above this trend line here, which is, in my opinion, substantially bullish for Tesla. We're getting way lower lows. We're getting way higher lows, and we're getting higher highs. This is a very, very good trajectory for Tesla. I love it. Even Lucid, look at Lucid. The explosion of risk is back. But again, the type of risk on we're going to is not like, oh, I'm going to put money in the stock market. I'm going to risk my money investing into Apple or Google. Because even Google, look at Google. A little drop here at the end. You're slowing, despite this insanely beautiful run, slowing to dropping. Look at NVIDIA. You've got a slowing here in the growth. At the same time, you're also going to recovery risk. Look at Dave & Buster's recent runs here. Look at Carnival Cruise Lines, riskier plays, especially going into the potential COVID winter. Folks, we are seeing a massive, massive rotation to risk. What can we do to potentially evidence this? Well, look at this, folks. Type it into Google. FINRA, margin, statistics. They just came out. And here you go, folks. Look at this. FINRA margin statistics. So how much debt we took out in August? $911 billion of total debt outstanding in August. I want to make that clear. Not taken out in August, but outstanding in August. This is huge. This is the biggest number we have ever seen in FINRA margin debt. I was really excited when we saw this slowdown here in July, where we actually had in 2021 the first inflection point to the downside in margin debt, and then all of a sudden it ticks back up. This is crazy. This is a big, big, big bump. We are now back onto that trajectory of potentially getting up to a level where we will be at over $1 trillion of margin debt. That's insane. Let's see here. Okay, now, how do we tie this together? Like, what do we conclude from this? And how do we invest? All right, so I'm going to answer that. First of all, I think when we go to a risk-on style of investing, we set up the market on shakier foundations. It means that high-quality companies, really, really, really good quality assets, potentially start rotating down, like those mega caps, the Apple, the Google, the Amazon, the Facebook, the Netflix, although I personally don't love Facebook, but I'm going to lump them in there anyway, okay? We potentially see a drawdown in those tech names. At the same time, maybe we see consumer staples move up as inflation concerns continue to press, and financials. Consumer staples could be things like General Mills. It could even be things like Caterpillar, right? An industrial. It could be things like, that's not a consumer staple, obviously. That's an industrial. It could be things like Target, back to consumer staples. Walmart, right? Those could do decent in-person spending and maybe companies capable of raising prices. Staples, you tend to have more of an opportunity to raise prices. Discretionaries, you tend to have a lower opportunity to raise prices. Those would be things like Restoration Hardware or even Etsy.com, which I love Etsy, okay? That's a big holding of mine, all right? So shoot myself in the foot. But I'm always going to be honest. Like, it is what it is. And so if we're seeing this rotation away from potentially, I'm going to say it, the safer cryptos. I'm saying that because I don't want to compare cryptos to Apple and Google in terms of safety, okay? Some people might. I'm not going to make that comparison. I'm just saying, if we potentially see this drawdown in safer cryptos, ADA, Ethereum, BTC, at the same time as maybe seeing altcoins, NFTs go speculative to the moon, at the same time as we see some of the higher quality tech companies fall down in favor of potentially some more speculative, stocks or whatever, there are two things that could happen. One, we could actually end up seeing a glorious rally in some of these speculative stocks. I mean, like, insane rally in some of these speculative stocks. I mean, look, let me ask you, okay? What fundamentally underpinned Plug Power's rally? And look how long it lasted, okay? January to about February 12th. So about 6 weeks. What underpinned a 6-week rally of Plug Power to, basically 2.5x in value? What underpinned that? Nothing but momentum, hype, and potentially debt, right? What underpinned QuantumScape going from, what was it over here, $26 to 5xing to 132 in a matter of a month? Maybe a little bit more than a month. Yeah, about a month. What underpinned that 4-week rally, right? Now, that's something else to keep in mind, is the market we're in right now is one such where we're not even seeing 4 to 6 week rallies anymore. We see these shorter term rallies. Like Robinhood had this maybe week and a half rally and then started fizzling. Again, coming back a little bit. But you see these shorter term rallies. So is it possible that we're going to go into this market where all of a sudden this, I really think it's a good analogy, even though it sounds a little derogatory. Imagine this sort of group of sheep, and then you have like 10 different farms, and those farms each represent different stocks. And then all of a sudden it's, all right, everybody, today we're going to Canoe, and then the stock goes up, right? And then, all right, everybody, today we're going to Plug Power, stock goes up. And some sheep end up staying at each of these farms. So you end up getting a slightly higher price. But the more and more the crowd kind of runs around to all the different farms, the more and more we're actually pumping up these stocks as people take on more debt and start looking for riskier and riskier assets. Now, in my opinion, trading-wise, and this is where the strategy comes in my part, trading-wise, I want to know that, okay? Because as a trader, I want to be able to play with the sheep, but get out early. That's the thing, is I am willing to take my tendies early, take your profits early, and move on to the next one. And then just sort of wait until they finally come to you and then move on early again, right? That's just my kind of conservative nature. But again, my trading portfolio is a fraction of my fundamental portfolio. Generally, probably trading is going to be certainly under 20%. And 80% is going to be long. It's money I kind of lock away and I park, and I don't want to pay taxes on that money. Everybody should have their own ratio. I like the 80-20. Now, at the same time, with my long fundamental portfolio, I want to be very careful that when I establish positions, I don't do so on hype periods of time. So I have to be careful. Like, I really want to have $500,000 invested in Matterport. I sold my Matterport early on the last big run. I made a lot of money on it. I'm up to about, let's see, double and a half, so 150% in just the summer. That's just summer trading from April to now, not the money I made before or the money I expect to make. But I'm not going to put $500,000 into Matterport, especially because I expect this thing to go back down to $17. Now today it's down 7%. That's fine. Like, it's at $20. Please go back down more. Please get to $17 so I can invest in it more. Now I will DCA in, so I might go 50, 50, 50, but I'm not going to go up to 500 until I get to my target numbers, and then I'm going to go big because I want to make sure the sheep that are going to leave are going to leave. Get them out. I would make the same argument. If I wanted to establish a long position on something like Dutch Bros, am I going to get in at peak euphoria at 62? Of course not. I expect it to be a trader meme. It did so well for so long, so many days in a row. I'm not going to put money into it. It's the same thing with Toast until it gets to a reasonable number again, or at least until I feel confident that the traders are gone. Look at Dutch Bros. It's down 10.29% today. Look at Toast. It's had its first 2 to 3 days really in a row here. I can't even get the symbol. There we go, TOST. So if we go to the normal candlestick here, you'll see, well, that looks a little harsh. Let's go to the hour here. I mean, it's true, but yeah, anyway, you can see Toast on its IPO day ran crazy to $66. I made a video about Toast, and I said I think the valuation is way too high. And it did very well at the open. It still traded up in after hours the next day, but it's been actually straight down since then. So yeah, the day chart is actually accurate. And so that's where people kind of go in. It's like, oh, it's going to be the next Dutch Bros, right? But remember, short-lived. So whether you're trader or fundamental, remember, the movements are short-lived. It's even, for example, and this is one where I should have recognized this, okay? I will always tell you my mistakes and my successes. I want to give you a balance of both. I invested in Hippo right here. It's about right here, 490, 480, right around here. Something around here. It could have been on this side. Yeah, it might have been on this side, like that 9-3 date. That's what it was, 9-3. I thought this dip was perfect. I liked it. I thought we were at the beginning of a potential trend up here, which we were, but the problem is it was a sheep example. I had a call option on it. I got out early on my call option. I made over 6 figures on that. I did really well on that. I probably closed my call option somewhere around 625, so not fully peaked. But in terms of my shares, I held my shares, as I promised I would, and unfortunately, as the sort of sheep left, that motion left, I'm basically at kind of where I bought it, maybe down about 15 to 18 cents a share on that. Not a big deal, but it's worth noting. When you're a fundamentalist, that doesn't mean you were wrong. It just means the real fundamental rally has not actually happened yet. Very important to analyze these things. So things that I think are potentially other opportunities for your longs, though, are stay away from, for longs, don't bag hold momentum stocks, okay? But look at something like DocuSign. We know DocuSign is not a momentum stock. It's selling off, though, probably as people are taking money from this and getting into those momentum stocks, those movement stocks, the ones that just rally like crazy and come back down. That, to me, is an opportunity to build positions in things like DocuSign. You want to build positions for fundamental purposes when people are not looking. CrowdStrike, another one, starting to trend down. There was another one, Cloudflare, cybersecurity firm, just starting to trend down. And this is what I like. I like those long opportunities, but I want to be very, very careful that I'm not kidding myself in establishing longs in things that are either really frothy on valuations because they just came out of an IPO, or they're momentum stocks. I time and time again hear people say things like, hey, Kevin, I bought something when it was really risk on, like Fastly, for example. People buy something when it was really, really risk on, and we had some crazy rallies there towards the end of 2020 there. But Fastly also participated in that sort of crazy January to February run right here, and just sort of bled out since then. Now, if I'm holding on to something after massive momentum and it bleeds out, and I got to ask myself, why did I buy it? If I bought it because I thought it was going to the moon, well, that's not a reason to be in a stock and it's time to get out. Now, personally, okay, between you and I don't own any yet, but I'm looking at Fastly as, hey, can this be a turnaround fundamental story? Because nobody is freaking looking at it right now. Nobody gives a crap about Fastly right now. It's not sexy. There's no momentum. It is the dirt field that has been stomped on and everybody has left. Everybody cares about this crap because it's green. But you got to be careful, folks. This is where you can get hurt. Look at that, another rally over here. The Sun Power rally from January again to February 19th-ish. We get the signal prey on the Bloomberg terminal, and what happens? Boom! Plummet. And so now this is where it's time to do real fundamental analysis. Hey, is it fundamentally worth around 23 bucks? What about ChargePoint with the lockup expiration coming tomorrow, right? But again, want to be very, very, very crystal clear here. This is a very unique market because people are going risk on risky assets. And that makes sense. When you go risk on risky assets. I love that for my fundamental portfolio because while everybody goes nuts over where all the sheep are today, I am going to be hunting for bargains. And that's what I'm hunting for. And I highly recommend that, honestly, play both sides, okay? Play both sides. If you're going to play with the crowd, do that. But remember, that is not your position to build fundamentals. Do not call your bags on momentum plays your fundamental investments. Do not kid yourself. In fact, the best thing for you to do, and this is what I talk about in Stocks and Psychology of Money, the best thing for you to do is write down when you make a trade. I am buying GVO because it's going to the moon. Okay. All right. Then let's be clear. Don't bag hold it when it's down 30% over the next, 3 weeks or whatever. I am buying DocuSign because it's a fundamental play that has been discounted. In fact, the more it keeps falling, the more I'm going to keep buying. And I would even write this down. I'd go, if it drops to 190, I'm going all in, right? That way, when it's 190 and you're like, oh, crap, man, I bought so much at 250 and then it actually did go to 190. You don't sit there like a paper hanger going, I'm too nervous to buy it. You wrote it down. You knew it would happen. It's kind of like with SoFi. SoFi, I invested in I sold puts because the IV was insanely high. I sold puts when the stock was $17.50. But I wrote it down. I put it not only in my alerts, but I also put it on my public.com profile. I put in, I believe there's a good chance this is going to go down to 1480. It ended up going down briefly for like a day to 1380, bounced around 1480 a while. It was a good support line nonetheless, even though we had a brief dip below. I bought shares, saying literally on my public profile, I got them right where I want them, and the thing's back to $17 now. That's what I expected. And my sold puts printed tendies, and I also bought shares towards that low end. Why? Because I wrote it down. So freaking important. And so that's why this is a very important video on the market rotation. And I hope that you found it helpful. If you did, make sure you subscribe to videos like this, because if you don't subscribe, I have no idea if you like them or not, because after I post videos, I can go through them and I can go and see which videos people like, and then I make more of those. Makes sense. That's how media works. People are always like, how come they always make more Trump videos or Trump news articles than they make Biden ones? Because whether you love Trump or you hate him, the Trump ones are much more entertaining and they get more views. Okay, folks. Thank you for watching this. I hope you found it helpful. Goodbye.